to see quite number of participants joining us this evening. At the moment, already almost 50% joining in this beautiful Friday evening. So first of all, I'd like to express our sincere appreciation to IKPI Jakarta Selatan for organizing this event and for its continued support in creating opportunities for learning, networking, and professional development among tax practitioners. Thank you, Pak Sahata, Ibu Lili Cita Dewi, and team. And now I'd like to invite Pak Sahata, the chairman of IKPI Jakarta Selatan, to share a few opening remarks.
Okay, thank you, Pak Triadi. Good evening, everyone. Welcome to English Club IKPI, hosted by IKPI Jakarta Selatan. So actually, we initiate from IKPI Jakarta Selatan, so we hope and later will be national. So this is we study. So our topic this evening is transfer pricing 31. What the guidelines don't tell you. So for more than 3 decades, transfer pricing has evolved from the technical issue into one of the most important areas in the international taxation. So today, multinational business face as increasing scrutiny from tax authorities, more complex regulation, and greater documentation requirements. Yet many transfer pricing disputes are not caused by what the guideline says, but by how they are interpreted and applied in the practice. This is why tonight's discussion is especially relevant. We will explore the practical challenges, gray area, and professional judgment that often arise beyond the written rules. We are privileged to have Mr. Iwan Ho, head of the transfer pricing practice KPMG Indonesia, as our speaker. And we are also honored to have Mr. Triadi Mukti, partners at EY International Tax and Transaction Services, as our moderator. On behalf of IKPI Jakarta Selatan, I would like to express our sincere appreciation to both gentlemen for sharing their experience and insight with us. I encourage all the participants to actively engage and ask questions and make the most of this opportunity to learn from two distinguished practitioners in the field. Without further ado, let's begin. Thank you, and I wish you all an insightful session. Thank you, Pak Triadi.
Thank you very much, Pak Sahata. And before we kick off the session, let us take a moment to honor our nation by listening to the national anthem and Mars IKPI.
Indonesia tanah airku, tanah tumpah darahku. Di sanalah aku berdiri, jadi pandu ibuku. Indonesia kebangsaanku, bangsa dan tanah airku. Marilah kita bersatu berdiri untuk selama-lamanya. Indonesia tanah pusaka, sangga kita semuanya. Marilah kita berdoa, Indonesia bahagia. Suburlah tanahnya, suburlah jiwanya, bangsanya, rakyatnya semuanya. Sadarlah hatinya, sadarlah budinya, untuk Indonesia Raya. Indonesia Raya, merdeka, merdeka, tanahku, negeriku yang ku cinta. Indonesia Raya, merdeka, merdeka, hiduplah Indonesia Raya. Indonesia Raya, merdeka, merdeka, tanahku, negeriku yang ku cinta. Indonesia Raya, merdeka, merdeka, hiduplah Indonesia Raya. Indonesia tanah yang suci, tanah kita yang sakti. Di sanalah aku berdiri, jaga ibu sejati. Indonesia tanah berseri, tanah yang aku sayangi. Marilah kita berjanji, Indonesia abadi. Selamatlah rakyatnya, selamatlah putranya, pulaunya, lautnya, semuanya. Majulah negerinya, majulah panggungnya, untuk Indonesia Raya. Merdeka, merdeka, tanahku, negeriku yang ku cinta. Indonesia Raya, merdeka, merdeka, hiduplah Indonesia Raya. Indonesia Raya, merdeka, merdeka, tanahku, negeriku yang ku cinta. Indonesia Raya, merdeka,
Okay, thank you everyone for taking the time to join us on this Friday evening. We truly appreciate your presence and your commitment to continuously broadening your professional knowledge while at the same time improving your English. For those, well, I think Pak Sahata has introduced me, so I don't have to introduce myself further. The topic for this evening is very interesting. Transfer pricing turns 31. What the guidelines don't tell you. So I didn't know transfer pricing has been that old. I thought it has just been introduced not long time ago. We are especially honored to have an outstanding guest speaker with us tonight, Pak Iwan Hu. Pak Iwan Hu is the head of transfer pricing practice in tax services for KPMG Indonesia and has over 30 years experience in transfer pricing and tax. Prior to joining KPMG Indonesia in October 2010, he was with KPMG Global Transfer Pricing Services Group in Singapore for almost 4 years and in the Netherlands for more than a year. And before that, he worked with the international tax group of another Big Four firm in Amsterdam and Jakarta. Pak Iwan was involved with various projects such as transfer pricing documentation, planning, and audit events, as well as advanced pricing agreement negotiations. So with his extensive experience and deep expertise in transfer pricing, I'm pretty sure that tonight's session will provide a valuable insight and a practical perspective for all of us. So although actually Iwan is a very Indonesian name, is it? But he is actually Dutch, not Indonesian. Some of you may be curious about that, so I'll let him explain a bit about the history behind his name later. So before we begin, I would like to encourage everyone to actively participate in this evening discussion. This event is designed to be interactive, so please feel free to join the conversation. Don't worry, this is a friendly and very supportive environment. It's safe, there will be no judgment here, right? So without further ado, let us begin our session and make the most of this wonderful opportunity. Pak Iwan, the floor is yours.
Okay, thank you, Patriadi. Maybe I should start with that. I know several of you, including Patriadi, from when I was first in Indonesia, 2001 till 2004, with another Big Four. That was PwC, by the way. But I don't put that in my KPMG profile, obviously. So, no, very honored to speak here, and I would like to start in 1995. Many of you may not remember 1995 very well, but 1995 was a very important year, and why? Well, first of all, Indonesia was turned 50 years, but that's not what we are talking about here. Iwan starts working. Now, why is that important? I think I grew up in Amsterdam, as you mentioned, then went to uni, and I walked into Pricewaterhouse, and they asked me a technical problem. I was very proud to solve it, and then they said, "Can you please write an advice about that?" Okay, difficult, in English, and I was like, "Okay, I've never done that before." So I think we all starting at the same starting point where you have to write incredibly complicated things in a language you're not actually, which is not your mother tongue. And so it's already difficult enough to understand some of the tax and transfer pricing principles, but to write about it in a different language, that is really difficult. And so that is to set the scene a bit, because what also happened in 1995, the OECD transfer pricing guidelines were issued in June 1995. So it's really 31 years since the international principles started. And why is that important? Because the OECD guidelines are, as the name suggests, guidelines, but somehow the entire world uses them to set up their transfer pricing systems. So there was one holdout, Brazil, until last year it did something different. Now, obviously, if you have cross-border related party transactions and you use system A and another country uses system B, well, it's already difficult enough if everyone uses system A. So with two different systems, that is not going to work. So luckily, there are the OECD guidelines. And I happen to be in the group where the partner decided, I'm going to start a transfer pricing group. And he needed to have, well, himself, a manager, a senior, and me. So I read those OECD guidelines and I read them on the beach. I actually remember that. And because I took them on holiday and I read them and I was like, now what is this? So that is actually what I wanted to start with. What is transfer pricing? Because that is actually a more difficult issue than it might seem at first. So if I start with that, what is transfer pricing? Well, transfer pricing has been in the news quite a bit lately in Indonesia. And if I look at the headlines, profit shifting by multinationals, this Jakarta Post by the looks of it, and profit shifting would boost public revenue. And we have a couple more. And what is the guiding principle of all of these? It says under invoicing, it says profit shifting. And somehow in Indonesia, these terms are used as a synonym of transfer pricing. But in my view, and that is what this presentation will, the first part will be about, this is not transfer pricing, because this is profit shifting and this is under invoicing perhaps. So the big question arises then, what is actually transfer pricing? I have a very simple example, which is here. Batikin is a Spanish group. And the Spanish group actually has an Indonesian subsidiary, PT Batikin. If you're well versed in Indonesian law, the 100% ownership is not possible, but for the sake of this presentation, bear with me. So if we have Batikin and PT Batikin is a manufacturing entity, as it says here, and we have a headquarter. So what happens? Well, PT Batikin is manufacturing things and sells them to Spain. And somehow in Indonesia, we're making batik dresses. And what Batikin Spain obviously does with the dress is they find a customer and sell the dress. Now, what is the customer willing to pay for this dress? Well, it depends, of course. Is it branded dress? What is the quality? Is it actually popular? But for this example, let's say this Spanish lady is willing to pay $100 for this dress. So this $100 is not a related party transaction, obviously, because this is a negotiation with a random lady. So this is the same thing as me walking into Plaza Indonesia and buying a batik dress or a batik shirt. So any price that is negotiated between me or accepted by me and set by the vendor, that is the price. It's perhaps even the market price. So Batikin SA in Spain obviously needs to pay to Batikin in Indonesia. But how much should they pay? Should they pay $100? Well, obviously not, because Batikin does something. So in this example, we see that Vatican SA should probably be paying less than $100. But how much should they pay? And that's what transfer pricing is about. Because perhaps we can say Vatican SA needs to get some kind of margin. So let's say they need to get $5 margin, which means that we have $95 of revenue left in Indonesia. That could be the transfer pricing methodology. The other transfer pricing methodology could be that we say, okay, how much did Batik Indonesia spend to make this batik dress? Well, let's say $50. And they also incurred, so they need to get some kind of profit on it. Let's say the profit is $10, so we need to sell it for $60. So we leave $40 in batik in Spain. Do I see any under invoicing here? Question mark. Do I see any profit shifting here? Question mark. Well, the profit shifting would probably be encouraged if based on the tax rates. But if we look at Batikin, what is the tax rate in Indonesia? Well, I already put it there, 22%. Everyone should know that. Batikin Spain, what is the tax rate in Spain? Well, Google gave me that, and the tax rate in Spain is 25%. So where would the Vatican group rather pay taxes? In Spain or in Indonesia? If you pay the taxes in Indonesia, you pay less. And the interesting thing is that the Indonesian tax rate of 22% is actually not that high in the global context. Many countries actually have a higher tax rate, and maybe like the US, they might seem to have a lower tax rate. But in those countries, you don't only have the countrywide tax rate, but also local taxes that are added up to the tax rate. So even if the tax rate in the US is 21%, the effective tax rate is actually much higher if you add up the California or wherever that parent company is located. So I think the first misconception that I would like to take away here is that there's always profit shifting going on, because the tax rates, the multinational companies are not necessarily paying less taxes in the counterpart country. So this is obviously a very simple example, and in real life, you don't really see this. So we can make this slightly more complicated. And the complication comes in this scenario. So we have a Spanish company, and they own a Singapore entity, and Batik in Indonesia is now owned by a Singapore company. What happens in this case? Well, kind of the same thing, because Batikin still makes that nice batik dress. But actually, the group wants to sell it to a Spanish lady still, so they need to sell it to the Spanish entity, and the Spanish entity still sells it to the Spanish lady. Now, in this example, we have 3 entities, and before we had 2 entities. But does that mean that the Spanish lady is going to pay more? Of course not. She doesn't care how many entities there are, so she still pays $100. But the trick here is, of course, for the group, this makes a difference, because Spain needs to pay to Singapore, and Singapore needs to pay to Indonesia. Now, is here profit shifting going on? Well, first of all, we need to think, of course, what could the transfer price be? In my previous example, I said, well, it's definitely not $100. It should be less than $100. How much? Well, that depends. And here in this example, we have Singapore, and Singapore has a tax rate of 17%. So in this case, the group might be tempted to have more profits in Singapore. Now, how are we going to determine what is the proper transfer pricing policy? Is that $100 that Spain receives from the Spanish lady, does that say anything about how much the transfer price should be between Spain and Singapore and Singapore and Indonesia? Probably not. So here we have an interesting dilemma, because what are we going to give to those entities? Now, in transfer pricing, what we do is we don't look at that price. What we do is, what do these companies do? And what do they do it with? And if they do it, what happens if things go wrong? And this is what is called the functional analysis. So in the functional analysis, we look at what are the functions of the company, what are the assets of the company, and what are the risks of the company. Assets, we can start with that. And of course, this is not covering everything, but just to give a flavor, PT Batikin has a factory because they're making stuff. So they have a big asset and they need financing for the asset. So yes, they're having an asset. Would Spain have an asset? Well, not the factory, obviously, but including there are probably two things that are important in this example: is who designed the dress and is the dress branded. Now, the trouble with these examples is, of course, that you can debate on a batik dress who actually designed it, because was that Spain or was that Indonesia? And I purposely took a debatable situation because that's nice, because is a batik dress really going to be designed in Spain? Probably not. So that could create some complications. But is the brand in Spain? That could be. So the analysis of the assets don't only look at the fixed assets, but the what you call this, the intangible assets. They are actually the ones that are causing the most difficulty, because they are invisible and they are not that obvious. And oftentimes they're also not in the balance sheet, because if Batikin SA developed the intellectual property themselves, it wouldn't be on their balance sheet. So these are tricky things. The next question is, of course, what did they do? Because the assets was easy, the functions. So head office, manufacturing. So what we would do is we would conduct interviews with all of the Batikin entities to see, okay, who does what? Who are the decision makers? And in this example, we have something interesting, because where is the negotiation in the price going on? Is that PT Batikin? Well, PT Batikin and Singapore or Spain, regardless where, that is a related party transaction. So we cannot really say that these parties are negotiating the price. But the Spanish lady is, of course, paying to the Spanish company. And if she likes the dress, she might pay $100. If she doesn't like it, she might go to the competition. So maybe Batikin SA discovers after a while, well, maybe that $100 was a bit ambitious. Maybe we need to sell it for $80. And then who makes that decision? Is that in the headquarters? Is that in Singapore? Is that in Indonesia? And for this example, it doesn't really matter, because you would investigate all of the functions and all of the assets and say, okay, what does this mean? What is the most important entity in this group? And which entity is actually the simpler entity? Because the nice thing about the simpler entity in this example is that it's easier to determine the transfer price. The last thing that I mentioned was actually the risks. And this is an interesting one, because assets are somewhat difficult to move, because the factory you cannot move to Spain from Indonesia. The trademarks you can already move. Functions you can move, because if you have someone negotiating in Spain, you can send that person to Indonesia. Will the person like it? Maybe, maybe not. That's a different question. But people you can move, but it's not so easy. But that is the interesting thing about risks, because in my example, we have a very obvious risk if the Spanish lady doesn't pay. So she gets the dress, she gets an invoice, and she says, "Thank you very much. I will pay in 2 weeks' time as per the invoice," but she does not pay. And Spain doesn't get paid. Then we have a problem, of course. So that's called credit risk. And in this example, it looks like it's very simple that Spain has credit risk, but risk you can shift quite easily, because risk is a contractual thing. So if Spain would, for example, have an agreement with Singapore saying, well, if that Spanish lady doesn't pay, I don't need to pay to you. And Singapore has a back-to-back arrangement with Indonesia and saying, well, if Spain doesn't pay me, I won't pay you. And then the risk is all of a sudden in Indonesia. And that is a very simple thing to do with agreements. And the same thing, we have here a dress being sold for $100, which might be a bit strange in Spain. But if Vatican gets $100, that's of course a very different story than if they get, 1.8 billion rupiah, or 1.7 million rupiah, or 2 million rupiah. Because there's, of course, a foreign exchange risk if the dollar and the rupiah change. So the risk analysis and the functions and the assets, that is actually what determines the price. And at the end of the day, that price functional analysis determines the transfer price of $100 to Singapore and to Indonesia to become less. How much less? I don't know. Based on this example, it could be anything, depending on where the functions, assets, and risks are. So, but in any case, that $100 must be less, because both Spain and Singapore, they are doing something, they have something, and they run some risk, so they should get some share of the $100. Now, to bring that back to my previous slides on the pricing with DSI, Danantara Sumberjaya, there they say there's under-invoicing. Now, if you look at this example, what is under-invoicing? The interesting thing about the commodities here, the palm oil, the petroleum, and the iron, to a lesser extent, they are commodities. Now, for this batik dress, there is no published market price. But what is the interesting thing about commodities? There is a market price. So if the market price says the price is $100, or for a barrel of oil, $74, something. Yesterday it was 74. Then that is, of course, the price between the Spanish lady and the Spanish company. But if you followed my argument, if the price between Indonesia and whoever they sell it to, related party, that should be less than $100. So if the Indonesian invoice is less than the market price on that date, from a transfer pricing point of view, that is correct. How much less it should be, that is a very different question. But under invoicing, I don't think that term is very appropriate. It gives nice headlines, but from a transfer pricing point of view, it makes me shudder. And so that is my take on this discussion. Another thing is the Brent oil. That's an easy one, because you have a market price of $74. But for palm oil, there's another issue, that there is no agreed upon market price for palm oil. The price for palm oil is different in Indonesia, actually in every harbor in Indonesia, in Malaysia, and in Rotterdam. So which price should we use? Well, that becomes debatable, and then, yeah, the invoicing doesn't say anything about it. And another thing, for example, is this $74 for oil is the spot price. What if we sell oil, but in 3 months' time? What should that price be? I don't know, but there are people who can calculate that, but not me. And that is, of course, also you have to take all kinds of risk into account. And so we had the hedging and the forward price, and then there's the thing with palm oil, and especially with coal. There's now the issue of whether there's enough coal at PLN, but one of the things is that the coal apparently is of lesser quality. So how do you adjust a price for a ton of coal for quality? Well, for palm oil, that is apparently for coal, that's apparently doable because you can look at how hot does it burn. But for palm oil, how pure is it? So the whole conversation to look at the price and to say it's lower than the market price is really fundamentally wrong, because the market, which market price should we actually be using? What is the market price in this case? So that was the part on the sumber daya. Now I had this factory in Indonesia, PT Batikin, and what I would like to think about this company is I haven't talked about the risks yet, because I said that we have the assets in Indonesia, but what can we do to justify lower profits in Indonesia? Because after all, we're a business, so taxes are cost. So maybe we do want to lower the profit levels in Indonesia, but do it legally. Well, that is possible. What you could do is to go into contract manufacturing. So I said, we have a factory in Indonesia, but what does a factory actually do? And how do we justify the profit levels? Well, I mentioned the functional analysis, and here I should have the functional analysis. So what we should do is look at the functions, assets, and risks. And the assets, can we move the factory? Well, previously I said, no, that's hard. But you could, of course, sell the factory and rent it back. It's slightly difficult in Indonesia. In other countries, you could do that. Also, say Garuda Indonesia can buy planes, or they can lease them. So it is something you need to have a look, because if you buy the assets, of course, you have a lot more capital. You need a lot more capital. So your return on that, you would expect some return on that. But the factory is probably difficult to move. But can we move other assets? Yeah, debtors, why not? In third-party situations, it's called factoring. You sell your debtors to a bank, you sell 100 worth of debtors to the bank, and they give you 95. So they take over the risk or not, depending on what the arrangements are. Can you sell your inventory up front? Yep, you could. But in this case, I'm saying contract manufacturing, because who owns the inventory? Oh, that's actually an interesting one. Toll manufacturing, the term for toll manufacturing in Indonesia made me chuckle a bit, because maklon is an interesting word, because maklon consists of two words, M-A-K, mak, which in Dutch would be maak, which is to make, and loon is actually L-O-O-N, and loon means salary, gaji. So maklon is actually a reward to make stuff. So in case you're wondering about the roots of that word. But and the biggest difference between contract manufacturing and tolling is the ownership of the inventory. But in my case, and that is always difficult in Indonesia. So in my case, we have contract manufacturing, and we're looking at the functions. Said, which of these functions can we move easily? Well, purchase of raw materials, actually, and this is the what I find interesting about transfer pricing, that the purchase of raw materials, in this case, batik dresses, you would probably buy the raw materials in Indonesia, but not necessarily. Maybe this factory buys its fabric overseas. Could the head office then actually be doing those purchases? Yes. R&D, well, that's an interesting one. R&D is oftentimes not done in Indonesia. And you can go on in this list, assembling and packing. That is probably something that you really have to do in Indonesia. But this assembling and packing, is that a high value add function as compared to R&D? Probably not. I mean, I always compare it to jobs I did when I was in university in the Netherlands. Very normal there to do side jobs. So yes, I worked in a factory and I packaged goods. I had no education at that time. I had no idea what I was doing, but somehow it was going okay. Could I do production planning? Probably not. Could I do R&D? Definitely not. So some of these functions, of course, have a higher value than others. And also sales. In my example, I already mentioned that sales was in Spain. Invoicing, marketing, that's also a good one because we're exporting the one. So all of these functions the production planning, probably quality to an extent, quality control, very much back office, purchase of raw material, all of these functions we could move to the head office to make it into a contract manufacturer. So we move functions out, and that justifies moving profits out. Next is, of course, my risks. Oh, apologies for the poor slide quality. So the risks is R&D risk, financial risk. So what I mentioned before, you can shift all of these risks quite easily. And now, what is actually the source of all of these risks and functions? Because I didn't make them up myself. I actually looked in the Indonesian regulations. And this is an older one, because in Indonesia, transfer pricing started in 2009. And that's probably what Patriadi was referencing to. And so if you do the calculations, that's why I came to Indonesia in 2010, because Indonesian transfer pricing had started. And this is actually in older regulations. This is per 2013, so that one was already slightly later. But this one is quite old, and this one has a very handy list of all the functions and risks that you could come up with. Recent experience also shows that AI can also come up with this. So by moving all of these functions and risks to the head office, you could convert a manufacturing company to a contract manufacturing company. And that indeed justifies lower profit levels in Indonesia. And so, yes, you can do profit shifting, but the profit shifting needs to be, you need to build a case first, and then you can shift the profit. And then the last bit of that chain is that you have a price. So rather than saying, I see a price, and that means that the transfer pricing is wrong. No, the price is the result of the setting of and the implementation of your transfer pricing policies. That's a realization that I actually had when I was looking at this whole discussion. I think there's also should also be time for Q&A. So I will almost stop with this presentation, but there's one more thing. Actually, this is one of the first transfer pricing projects that I did in real life. So the Spanish headquarter was actually a Dutch headquarter. The Indonesian company was still an Indonesian company. Now, what did we do? We indeed said we move all the functions, and more importantly, we move all the risks from Indonesia to the Netherlands. Good, so we have lower profits. Now, I did this job in 1997. So what happened with this factory? I did this in end of 1997. In May 1998, this factory stopped production for quite a long time because it was 1998 in Indonesia. So all of the risks materialized. So what happened? All of the losses ended up in the Netherlands. So yes, you can have the best transfer pricing planning that you have, but it goes both ways. If you move the risks out of Indonesia, it's like a marriage in good times and in bad times. And bad times happen sometimes. Sometimes there's a flooding. Sometimes there is a volcano in Indonesia. And floodings, they really do happen. So that is one final thing. Yes, profits go out of Indonesia, but also the risk. So it could also very well be that the losses leave Indonesia. And I leave it at that. Thank you.
Okay, thanks very much, Ivan, for that explanation about transfer pricing. That basically that's a very important knowledge because it is yeah, that's the basic of transfer pricing actually. But for me, I'm just curious of what is actually under invoicing that the government is talking about. Because yeah, I think it is different from transfer pricing. Am I correct to say that transfer pricing is basically you determine the price based on the risk and the functions, but under invoicing is not that sophisticated. To me, under invoicing is just you actually have a transaction worth 100, but you only bill 80, for example. I think
Yeah.
it is that simple. But
Yeah.
the question is, yeah, because we are talking about commodity transaction. Commodity basically has an index, right? So it is difficult for you to do transfer pricing there. But uh, I don't know how could they under invoice because um, you have to go through customs, for example, right? And the
Yeah.
information should match.
Yeah.
So maybe you can share something about that, Taiwan?
Yeah, I think if you just invoice something for 80 and it's worth 100 and somehow you pay the 20, yeah, then you're talking about a whole different ball game. That's not transfer pricing, that's just fraud.
Yeah.
And yeah, in my example, if you especially if you have a Spanish group with an Indonesian operation, why would they set up something in Singapore? Well, companies don't set up a regional headquarters in Singapore because they like to go to Orchard Road for shopping. There must be a business reason. So what I see in practice is that you do this because you need to you have time difference with Europe, for example. So you need to have senior people sitting somewhere. And it could be that they're not sitting in Thailand and Indonesia and Malaysia. You want to put them all together in one location, and Singapore just happens to be a place that people like to go to. And so, but the most important question, of course, becomes then, what do you have in Singapore? Because there is a case from a while ago where an Indonesian group sold commodities to an island to a group entity in a tax haven. And yeah, that is one of those tax havens where you really don't have anything. You have a name, maybe you have a name on the door, probably not even that. And as I said, if you look at the functions, assets, and risks, well, if there's no one there, then you can still contractually shift risk there, but let's say you don't do that. You just say, oh, there's an entity there and we give them 5%. Yeah, what is the justification of that? The thing with Singapore is that many commodity groups, actually Indonesian owned, they do have real operations in Singapore. Actually, all of them do. Just look at the names of those 10 companies that are named there. They all have significant operations in Singapore. So the question doesn't become why are we not paying that alleged market price, but how much should we indeed give to Singapore? And Singapore, yes, if you want to really manage your risk, you want to do hedging policies, you want to attract capital, you want to attract loans, you want to do some betting on the market. Yeah, if those are really valuable things. And with palm oil, yes, the trees are in Indonesia, you cannot deny that. But everything else can be outside of Indonesia, and that means that should get a price. To the extent, for example, you have arrangements with natural resources where a foreign entity agrees to buy all of the production regardless. So what happens if we have a big fire in the plantation? Well, that means that 1 liter of palm oil becomes very expensive. Because you pay the pricing would probably be I don't want to go into transfer pricing methods, but basically all of the cost of the plantation plus a profit margin. So if that is your pricing system, then if there's a production problem and you only get 1 liter, that's a very expensive liter. But that, of course, changes the risk profile in Indonesia completely. It's like and it's a real life example. And the structure this is a consumer product I just mentioned, and you can still see on the packaging that the structuring is still in place. But 1998, 99, 2000, they weren't very happy in the Netherlands that they got all of the losses from Indonesia, because this is also, they didn't only do this for Indonesia, they did it with all the factories in the world.
Okay, thanks, Iwan. Let me open the floor if anyone have any questions or any comments. Just turn on your microphone and speak up. Because that's the point of this session, right? It is a conversation in English.
Yeah.
But we're talking about
6 minutes.
Let me try my English, Triadi.
Okay, go ahead, Bu. Bu
Yeah.
Lili Cita Dewi.
Yeah, thank you. Thank you for the opportunity. Iwan, thank you also for accepting our invitation to speak at this event. It is a very good explanation that you made. You do it calmly and step by step, which is very good. But I have question. This is about our daily works. Yeah. In many cases that a company will do a transfer pricing adjustment at the end of the year after they review everything and they know they are overcharged or they're less charged, then they do transfer pricing adjustment, which can be explained and it is matched with the transfer pricing document that they have already prepared earlier, ex ante, let's say. But when come to the tax audit, the tax auditor sometimes is not very fair. It is increase the revenue, they okay, but if it is on the opposite, they reject. Yeah. And the reason they use is actually they said that there is no such an underlying transaction. Yes, of course, we cannot show them which invoice was under invoice if it is under invoice and not under invoicing like the government says that it is a real one, that this is actually according to us the total transaction of our margin is too high, so we will have to have some more expenses like that. And the tax office said, please show us which one which is need to be reduced. And we cannot because we just do it at the end of the year after considering all transaction. Is there any antidote to those correction made by the tax office? Usually the tax office just asks us, just you know which country that you have, for example, have more expenses. So please just divide it to all the transaction. But we know that is not correct. Yeah. So I would like to listen from you. What is your advice in that situation?
Okay.
Thank you.
Thank you very much, Ibu Lily. Maybe I start with something. I feel very honored that Ibu Lily asked me a question and to explain about taxes, because technically Ibu Lily was my boss when I was at PwC in Jakarta. Ibu Lily was there, and so that's well. I think it's easiest explained by my wedding reference. It's the good times and the bad times. So, if you have an arrangement where the Indonesian regulations very much try to misuse the ex ante, the price setting principle. That was Pa Amin, in case you wonder. Pa Amin was at that time the director of international tax, and he had this idea about you have to set all of the prices in advance and then see what happens. But he took it one step further to say that if you say that the arm's length profit in Indonesia should be 5%, doesn't matter. Then if it is any lower, then the foreign entity needs to subsidize. So if the real profit is 2, the foreign entity needs to pay in 3. Okay, fine. If it goes the other way, in my view, it is the wedding reference in good times and in bad. So in good times, we need to pay out, and in bad times, we need to receive. The theory when this regulation was introduced was, well, if you make more than your budgeted profit, the price setting, the ex ante, then that needs to stay in Indonesia, because that is caused by the unforeseen benefits of being able to operate in Indonesia. Now, this principle, if I look at it on a global basis, is something that China and India were also doing in the past, but they have come back to it. They have already come back to it, but this is something that where there's a mismatch between the regulations that don't stipulate this, the DGT, that for in the context of APAs and MAPs accept this, and tax auditors who conveniently don't accept this. And unfortunately, there's not really an antidote, but conceptually it's wrong. And so one way to solve this is to bring this to MAP and APA, because the officers at the DGT, they are well aware of this. They have said in public, in our seminar, they don't like it, but they haven't said that they don't accept it. That was a very long explanation.
Yeah, thank you, Iwan.
Okay, thank you, Iwan. Thank you, Bu Lily. So, any other questions or comments, or anyone would like to share experience?
Excuse me, Mr. Iwan Ho, may I ask some question from?
Yeah, go ahead, Pak John.
Okay, I'm interested about the explanation about the underinvoicing, especially in Indonesia. What about the underinvoicing practical in Indonesia? Are there any case about underinvoicing in Indonesia? Is that affecting into Indonesia's economy? That's the question. Thank you.
Okay, thank you. Yeah, that's a difficult question, because that goes beyond transfer pricing. Obviously, Indonesia rightfully thinks that we have resources and we need to get a reasonable price for that. But if you just look at what is there on the market prices, you cannot apply it one-on-one. And what you also need to bear in mind with transfer pricing is that in this case, it is cross-border transfer pricing. So the tax authorities on the other side also need to agree with the treatment. Now, obviously, you would think that many tax offices would be more than happy to receive more. But that's not necessarily the case, because countries such as Singapore and Hong Kong and others who really depend on the trade, Netherlands to a certain extent, they wouldn't accept anymore that you put too much profit in those countries. Because as I was mentioning, you have APAs and MAPs where they will need to negotiate with other tax offices and show why did they accept that the transfer pricing system that was clearly not arm's length. There were too many profits in Singapore or in any other country. So many other tax jurisdictions are actually wary that yes, you should not have too little profit in their jurisdiction, but also not too much. Because there's another thing that you have these days, which is mostly overlooked, which is the CBCR, the country-by-country reporting. So every big multinational that has cross-border transactions needs to report their revenue and their profit levels and tax in every country. And soon, in many jurisdictions, those reports will actually be made public. Now, tax offices can request them. So the Indonesian tax office can get the CBCR from any other jurisdiction that deals with Indonesia for that particular taxpayer. But soon this will also be visible to the public, to me, but also to activists. So if you look at many cases that cause a lot of uproar, they are not necessarily starting in Indonesia, but in another jurisdiction where the case was actually discovered. So but the political and everything repercussion of under invoicing, that is something I'll leave to the politicians. Perhaps there's one interesting thing. Many of the groups that are accused of under invoicing everything are actually owned by Indonesians.
Okay.
Very different view.
Thank you, Mr.
When I'm back home in WA, I arranged a video hookup with her sister, Pauline Cook. Pauline was 4 years older than Chantal.
Iwan,
Yeah.
it's Philip Shah speaking. I just had a rather, common sense and practical question. Historically, tax officials and other government officials look at a company that makes losses and say they must be probably underpricing or cheating on taxes. What's your experience with the receptiveness or understanding of tax officials that many companies might have to make losses for some years to break into the market, or there are other reasons why there appears to be underpricing, but that's due to a genuine market strategy to break into a market? In other words, they're genuine practical business considerations, the short and the long term. Breaking into a market. What's your general sense of the degree of understanding and respect of tax officials for serious business considerations like that, where clearly companies might have to make a loss for a few years in trying to break into the market and be a success?
That is also an interesting question. I think if I look at the company, and especially if it's manufacturing, if that company is profitable from day one, then there's something wrong. Common sense is actually one of the major considerations in transfer pricing. And I think there's also a bit of a disconnect there because, yeah, the things that you mentioned, do we have a strategy like do we want to gain market share or how difficult is the market? Those items should all be recorded and justified in the transfer pricing documentation. And we do that, but the moment you make losses, in the Indonesian tax system, losses, overpayment, and you get a tax audit, and you know then what the practical implications, are. And here's the disconnect between the DGT and the tax auditors, because at the DGT level, obviously, and also at the legislative branch, they know this, of course, but for tax auditors, it is easy to say, yes, we should not be accepting losses. Now, the flip side of it is, and this is also common sense, or perhaps the fact that I've been married for a while, it's in good times, in bad times. So the question becomes, who should be bearing those startup losses? Because if you really say, okay, we do market penetration and those costs are borne by the overseas entity, then you become a limited risk entity in Indonesia, which means that theoretically going forward, if you make more than routine profits, you should be paying those to whoever sponsored you to set up the business. So, but if you look at it on a year-by-year basis, if we have startup losses, that means that going forward, there should be bigger profits. Now, I know that the tax audits are not over a period of 10 years, but a period of 1 year. So that's where the practical disconnect becomes very visible.
Thank you.
Okay.
Yeah, Iwan, we have one question from Pak Kosasi here
Okay.
in the chat box. Pak Kosasi, do you want to just turn on your microphone and read your questions?
Excuse me, Mr. Triadi.
Yeah, go ahead.
I question to Mr. Iwan Ho. What is the solution for the contract manufacturing company if it use RPM but use inventory solution? Is that permissible?
Okay, thank you for the question. I'm not entirely sure what the inventory solution is in this context. So unfortunately, I don't understand the question.
Oh, okay. Sorry, I cannot detail communication.
Yeah.
Sorry.
Now go ahead, Pak Kosasi. Perhaps you can explain what do you mean by RPM and inventory solution.
Jadi gini, Mr. Triadi, dalam kontrak manufaktur, jika menggunakan metode RPM, apakah bisa di cover dengan pembandingnya dengan inventory. Solusinya di inventory. Jadi ada kayak model split analisis gitu, menggunakan inventory dalam RPM gitu. Thank you.
And what is RPM stands for, Pak?
RPM apa ya?
Resale price method, I would guess, is one of the
Yes.
transfer pricing
Yes.
methodologies.
The resale price method.
Yeah.
Yes.
Talking about
Yeah, okay. Maybe I'll start with the resale price method. So resale, because I'm still not entirely sure about the inventory solution, but the resale price method is for my dress of $100 for the Spanish company. If they would buy that for $95, then they would make a gross profit of $5 and a gross margin of 5%, 5/100. So that's the resale price method. So you look at is the gross margin that an entity reports, is that reasonable? And I'll refrain from how you determine reasonable, but this is where it starts, because the resale price method you only use for buying and selling goods. So for contract manufacturing, you would typically not use the resale price method. So that is a theoretical approach to this question. But the inventory solution is still a bit of a mystery to me, unfortunately.
Okay, thank you, Mr. Ho.
Thank you, Pak Kasasi. Okay, any other questions
Yes.
or comments? Go ahead, Bu.
Yeah. Yeah, I would like to ask for the contract manufacturing company. You said that, Iwan, using the resale price minus, yeah, it is not recommended. So what kind of method that is more appropriate for contract manufacturing?
Yeah, so okay, very, very good question. So technically this is actually an interesting one because the OECD guidelines have 5 transfer pricing methods. The cup method we talked about, so that looks at
Yeah.
market prices, the resale price and cost plus. And then you have the TNMM and the profit split. Profit split we rarely see in Indonesia, but what I would like to mention is the Indonesian regulation have three more transfer pricing methods, and I kind of forgot about them. But that is, of course, in my view, not very helpful, because if you have a cross-border transaction and Indonesia says we need to use transfer pricing method C, and the other country says, I never heard of that transfer pricing method, then you have, of course, the start of confusion. So why not just stick to those 5 transfer pricing methods? And we only use 2 of them anyway. The reason being, if we want to look at what are the proper percentages, we look in the database to find companies that have comparable activities. And there are technical reasons that go a bit too far why the resale price method and the cost plus method are rarely used in Indonesia, but that's because we cannot do a proper benchmarking. So what we end up is doing it on a net basis. So that is the transactional net margin method, where we look at operating profit and operating margin. And that is usually for buying and selling. And then for manufacturing entities, we usually look at the cost base. So how much does it, and I alluded to it actually in my example, the production costs are $50 and I put $10 of profit on that. That is the most common methodology for contract manufacturing. Look at the cost and mark it up.
Okay, thank you, Iwan.
All right, we have Agus Hadi for the next question. Go ahead, Pak.
Hello, Mr. Iwan, can you hear my voice?
Yes.
Okay, thank you. First of all, I follow your Instagrams. Thank you for your spread, your daily activity in your office. Okay, you talk about the transfer pricing. I want to ask, the transfer pricing audit will result into type adjustment, right? By one primary adjustment and secondary adjustment. We understand if this apply to cross-border transaction, but how about domestic transaction? This is because secondary adjustment are treated as construction dividend, where the under income tax law, domestic dividend are exempt from taxation. How should we respond to such adjustment about for the secondary adjustment? And then for second question, and I want to know what are the practice regarding secondary adjustment in other country, Paiwan? Thank you.
Okay. Thank you so much for that question. It's a very good one, and actually, I'm very happy with the second question because the secondary adjustment is not something particularly Indonesian. Secondary adjustments we also did in the Netherlands. Now, what is a secondary adjustment? And there I need to apologize because I'm not an accountant. I'm a lawyer by training. I worked with accountants for quite a long time, but here we have, and many of you have an accounting background, so bear with me. So what happens if the profit levels of a company are lower than they should be? Let's say we sold at the price that is too low. So that means that we adjust the revenue. So the revenue goes up and the profit goes up. Now, if you look at the annual financial statements of the company, then you wouldn't see that because it's only a tax adjustment. You wouldn't see that there was more profit in Indonesia. But the profit is gone. Now, normally, where do you book the profit if you, you book it into the retained earnings. And apologies to any accountants here. But they're not there. So what happened? Because you actually did not receive that higher income that would have been arm's length. So those retained earnings that are not there anymore, they have been distributed as dividend. So that is how that is the theory behind the secondary adjustment. And that is also why you can solve it by still paying in. So you can as a cash, you can still say, okay, I accept it. This profit level was not good. I pay more afterwards, and you put that through the books, and then everything is solved. And then you don't have you don't need a secondary adjustment because your retained earnings are higher. Or the final solution that is also somewhere in the Indonesian regulations, apologies, is that you can say, okay, this is I didn't get it in cash, but it's a receivable on whoever the counterparty is or the shareholder. So you book it in the receivables rather than in the retained earnings. I hope this makes some kind of sense. But this is approximately the cross-border theory. Now, can you also apply that in a domestic situation? I think so, but you guys are much better at Indonesian taxation, of course. But if you apply this line of thinking, and this is the Dutch way of looking at secondary adjustments, but I'm sure that that the accounting treatment is more or less like this. Bearing my poor explanation, you would have the same issue for a domestic transaction.
Okay.
And this, by the way, also is the reason why I believe that before the regulation was there, I thought that the principle of secondary adjustment was actually already possible in Indonesia. And sometimes you saw tax officers do it without a specific legal basis because it's not needed, because it's just dividend, it's just retained earnings that are not there. So they must have been dividended out.
Okay, thank you, Paiwan, for your explanation.
Thank you, Bagus.
Yeah.
Okay.
I'm happy to talk with that further. I don't think this is a good topic for social media posting.
Okay. Any other comments or any other questions? Feel free. Just turn on your microphone and speak up.
Pak Iwan, uh,
He was trying to get Simon back in the country.
it's Philip Shah again.
Okay, good.
After the very detailed discussion, presentation and review of all the submission that tax consultants make to the tax office, if the net profit for the year, the margin for the year for companies in the same industry are quite different, appear to be the same business. If one company submitted its transfer pricing and its net profit for the year is just 5%, and a similar company is 10, have you ever encountered where the tax office says, we're still unhappy with your transfer pricing because you seem to be making a lower margin than someone else in the same industry?
Very good question. Thank you. Yeah, as usual in transfer pricing, you can this is a debatable one. I think it is similar to under invoicing in a sense, because the profit levels of a company don't tell much, because as you actually mentioned, in what stage is the company? Is it a startup? Is it an established company? Are we perhaps expanding the business? Are we contracting the business? Are we actually closing? So where are we? So you can never compare companies apple to apple. So, however, some countries have taken this to another level to make it easier for taxpayers. So they say, if you have a distribution company and the company makes 5 or 5.5% bottom line margin, we're okay with that. We won't come to audit you. If you report anything above a certain safe harbor, certain threshold, we're okay with that. So you can also turn it around and make it kind of, make life easier for a taxpayer. What we see in practice indeed is that they say, okay, and I'm just using these names because it's easy reference. Okay, Coca-Cola, why are you making less profits than Pepsi-Cola? Well, the tricky part there is the tax office cannot do that, because the tax office may have data on Pepsi-Cola, but they cannot disclose that data to Coca-Cola, of course, because that is secret data. So, and that is also an international principle in transfer pricing. Tax offices are not allowed to use secret comparables. And the way that it practically works in Indonesia is that the tax office knows they cannot do it, because if this case goes to court, they cannot disclose the information. So the tax office cannot use specific information from specific competitors. In the past, they have tried to issue a minimum profit levels for various kinds of industries. I see Bulili nodding. That was 2008 or something. And yeah, and that one didn't, the main criticism from a transfer pricing point of view, it doesn't take into account the functions and the risks. And if you take all the risks, if you have a limited risk entity, your profit levels have to be lower than a fully fledged entity, and that so it is very difficult to give guidelines for this, and even in Indonesia, it has been tried and abolished.
Thank you.
Okay, thanks, Philip. Any other questions for anyone? Maybe another couple of questions.
Yeah, I have question. Yeah, this
Okay,
is
go
Lily
ahead.
again. Yeah, Ivan. Actually, when we pay royalty, for example, to overseas related party for knowledge, because we, for example, producing something which is the knowledge is belong to somebody, so we pay royalty. And then the tax office come and they said, why you have to pay this royalty? Because it's not belong to us. The technology and everything is belong to our related party, so we have to pay. After 2 years, 3 years, 4 years, we're still producing the same thing. And the tax, it's very, apa ya, lucu lah. So the tax office said like this, why you have to pay royalty? You know the knowledge already. You got the knowledge. You do the same thing for 4 years, 5 years. Why you still need somebody to give you license to do that? You don't have to. So what is our strategy to answer those arguments? Thank you.
Okay, well, thank you. This is a very good question because this happens in practice, and I totally agree with the tax office. I use a very common sense approach if I look at sometimes I see production process, and I use the very simple measurement. Would I be able to do this? And in many cases, it's no. But I think over time, yes, of course, you start becoming good at something, and you can do it without support. So you do need to have some kind of justification why you still are paying. And usually this is something to the tune of, okay, the production process is very difficult and we use this technology, and our production process becomes faster, we keep on improving, or we have less waste or anything. I mean, that you would keep on paying for technology that loses value over time is, of course, something that would be odd. And what many companies also seem to be overlooking, and that is something they are looking more at, is many things are not anymore so much in technology, but also in relations. So what we see often in Indonesia is that we have suppliers to a big brand. So we have a supplier of car parts selling it to a car manufacturer, in Indonesian car manufacturer, but a foreign brand. So, but how did that Indonesian factory, my client, actually get that order from the car manufacturer? That was actually done between the head offices in Germany, in Japan, or wherever the car is from. So the relationship and getting this contract and the negotiation and everything, that is perhaps what you actually should be paying for. But at the end of the day, I did say at the beginning, there's no profit shifting because the tax rate in the other country is higher. But there are, of course, many countries now that have actually don't have that much manufacturing anymore in the home country of the group. Actually, all of the manufacturing is all over the world in places where it's cheaper to manufacture. Let's be honest about it. So tax offices in those countries are actually trying to justify why do we need to get more payments to this higher tax country. But also the companies, because they have a lot of expenses, board of directors and stuff, in the head office. And those are deductible expenses, but in order to deduct, you need to have a base to deduct it from. So getting dividends from Indonesia, dividends are usually exempt. That's not going to help. So they need to create some kind of taxable income at the head office level.
Okay, thank you, Ivan.
Yeah, so intangibles is of course never black and white, but in principle, if there's a declining benefit of the intangible, of course you should stop paying.
But the problem but the reason why we paying continue is because this technology is actually registered as their intellectual property.
Yeah.
So we are using there, so we pay. But if the tax office asks whether we have the knowledge, yes, we do have the knowledge after several years doing the same thing. Is there any in regulation of transfer pricing or application that, for example, if we pay at the first year is 10%, let's say, the royalty, and then it has to be decreasing because it's only paying the right of them, but actually we don't really get benefit from that,
Yeah.
except that we're using their technology.
Yeah. Now, those agreements exist between unrelated parties because the usual benchmarking that many of us probably are aware of is that we compare companies with comparable companies, but we can also compare royalty arrangements with similar royalty arrangements between unrelated parties. There are other databases to do that. And yes, you see declining balance, balloon payments, all kinds of things that make life a lot more difficult. So it happens between unrelated parties, obviously. So in that sense, yeah, I think you do need to be looking carefully, and the benefit questions from the tax office are not totally unjustified.
Okay, thank you.
Yeah, thanks again, Bu Lily. Would say, well, can we have probably the last couple of questions before we close this? Anyone?
Excuse me.
Go ahead,
May
Pak
I
Faisal.
Mr. Iwan Ho, I'd like to ask some maybe two questions that I have in my experience, and I don't know is that good or bad. I don't know, but I talk about this in audit view. The question is, I have some case, there are multinational company, let's say in Malaysia, Philippines, and Indonesia. Malaysian company and Philippine company charge their cost in Indonesia. Is that true? And the second one is another case. I've seen an Indonesian company have headquarters in Germany. Any expatriate expense in Indonesia, let's say salary, apartment rent, any kind of cost, reimbursement into headquarters in Germany. Is that true from tax view, or is that related to transfer pricing? Mr. Ho, thank you.
Okay. Very interesting questions. I think I don't know the particular case, but if you say Malaysian and Philippines companies are charging cost to Indonesia, there's one thing that we are looking at here is, of course, the tax bill. But you also have the general business, and I'm not a businessman, I don't have an MBA, but just common sense again, is in the Indonesian general manager of the Indonesian entity going to allow other companies to make charges to this entity, because he has KPIs to meet. And so is he going to accept charges for nothing from abroad? The answer is usually no. What answers that we do get oftentimes is, if you ask, what is the charge from Malaysia? They say, there's nothing, there's some charge, and they do that, and we get nothing in return. That is a response that you often get, because that is the feeling of the Indonesian management. But you need to really understand what is the transaction behind it, because if it is indeed the global software or whatever, you need to always look at, have the services been rendered, and is there any benefit in Indonesia? Now, the Indonesian tax office, of course, takes that a bit to the extreme, but the fundamental question on services are those, and those are also in the OECD guidelines. So if you have a transaction between the Netherlands and Germany, the tax office would also look at the benefit and whether the services have been rendered. Because this is really factual in Indonesia and tax audits, it often goes a bit far. Which makes me think, oh, the expats. I think that is that happens, and that is indeed a question of what is the transfer pricing model. If you have a limited risk distributor in Indonesia and you're just setting up the business, yes, it could be that you actually put in people who are more senior than you would actually expect, so that the head office picks up the bill for that. Does it happen then that they still go on the Indonesian payroll with the recharge? Yes, otherwise you cannot get work permits and residence permits for them. You have to put them on the Indonesian payroll, otherwise you cannot bring the expats into Indonesia. That's a practical answer, not a tax answer.
Thank you, Mr. Ho.
Yeah. But then again, of course, if you recharge that, then yeah, those expenses are in your case, the German head office. So in the future, if the operations in Indonesia become really valuable, then the profit should actually go out of Indonesia, because Germany supported the Indonesian operations when they started. So they should get additional remuneration for that in the future. Or if Indonesia goes bust, then they have to pay for everything if the market penetration actually didn't work.
Thank you, Mr. Ho.
Yeah.
Okay, thank you, Pak Faisal. The next question will be from Ibu Talita. Go ahead, Ibu
Okay.
Talita.
Mr.
Yeah.
Iwan, I have some questions. So we are currently facing a transfer pricing dispute with the tax auditors, and the auditors is essentially saying your transaction with independent companies earn X% profit margin, you earn Y% for affiliation. And then they just add the difference to our revenue. And then they argue that our profit margin should match the profit margin of the independent comparables they selected. However, based on the 5 comparability factor, these companies are not truly comparable to our business. And then we are using the TNMM method. So our actual profit margin falls within the arm's length range in interquartile range, derived from the comparable companies with typical list.
Yeah.
And we believe our results are already within the arm's length standard and should be considered to be in the safe zone. And then the auditors have made an adjustment by directly applying the margin difference to our sales revenue. So, Mr. Iwan, in this situation, what would be the best way to challenge or defend against this adjustment from our tax auditors?
Okay. Let me first set the theoretical scene. So you're using a transfer pricing methodology that looks at the bottom line margin, and you say we're making it was sales. So let's say we're making 5%, and we have comparable companies that doing more or less the same, and they make between 3 and 8%, so 5%. I'm good. That is the TNMM method. The tax office is actually using a different transfer pricing methodology, because they're comparing the margin on sales to related with sales to unrelated. Now you can put up a big theoretical discourse on which transfer pricing methodology it is, but that's essentially what happens. So the first question becomes, which transfer pricing methodology is more appropriate? And to have a look at that, it's a bit of a chicken and egg, I think. First, you would be looking at, can we indeed compare the profit margin on the related party sales with the sales to unrelated parties? And there, I would like to refer back to the list of functions and risks, because if it's a factory, then you probably use the same assets, but are the functions the same for the sales to related and the sales to unrelated parties? And that's a question back to you. If you're looking at the, I'm having a peek at my slides now, the production planning and everything is the same, but how are sales to related parties different from sales to unrelated parties?
Okay.
And
So we
where is
need
the
to
credit
check
risk?
more about our VAR analysis too, right?
Yeah. Well, roughly speaking, if you sell to a related party, you don't need to worry about being paid, so you don't have credit risk. Oftentimes you work on the basis of pre-agreed volumes during the year, so you have less of a market risk. And for sales to related parties, you don't have to do sales and marketing. And that is actually the big ones, the big difference, usually the big difference. So because if you sell directly to an unrelated party in Indonesia, you have to negotiate the price and whatever. Whereas if you sell a whole bunch to overseas, you don't have to do that. So that is normally the justification why those two sales flows are not comparable. So, and that's why you cannot use that transfer pricing methodology. And that's why the TNMM bottom line is the only option left. Does that make sense?
Okay. Thank you, Mr. Iwan.
Yeah.
Thank you, Talita. Anyone has any other questions or any comments? Maybe you want just from your observation, how do you think the maturity level of Indonesian tax office in terms of transfer pricing? I mean, we've heard from the questions that the tax office sometimes has their own approach, their own understanding, and which sometimes result in unreasonable assessment.
Yeah.
So does it also happen in other countries? If you have the information, like probably Netherlands,
Yeah,
or Singapore.
I think I think there's a bit of a difference who you talk to about transfer pricing. If you talk with DGT officers who negotiate on a daily basis with their counterparts in other countries, that is a whole different ballgame. Transfer pricing has this thing, it's not black or white. I mean, with say Article 26, the rate is X% and maybe lower under a tax treaty, but it is black or white. In transfer pricing, you can in many cases debate things, but if I look at one thing I haven't posted about yet is if I look at the practical implications of transfer pricing audits. I looked at the Dutch guidelines to transfer pricing auditors. So what they say is, well, you have to read the local file first. Then you need to do your research to understand the business and to understand the industry and to understand where this company is in its maturity and all of those factors, and how is the industry doing in the Netherlands and on a global basis. And if you have any questions left, ask the taxpayers. What happens here in Indonesia is you submit the local file and then the tax office gives you the PER 22 form. Well, when I saw that thing first, my response was, well, please read the local file. You find all the information, and probably better than PER 22, because PER 22 is manufacturing only. So if you have like an I don't know, GoTo or Grab, how do you fill out your per 22 for that company? Good luck. But so, and then you get a lot of unreasonable things, and that, it's the Indonesian tax office is legendary for the cherry picking, where and we of course get the responses, and you do as well probably, or your transfer pricing colleagues, that if you talk with EY in Germany, what is the Indonesian tax office doing? Yeah, we get that all the time. I don't know if our colleagues overseas are more critical than yours, but so it is getting Indonesia. The foreign perception of transfer pricing in Indonesia is not very great. It used to be that if you looked at risk assessments long time ago, usually companies would say the most difficult ones on transfer pricing are India and Indonesia. India is off that list it went off that list about 10 years ago. So that is perception that I hear from people outside of India.
Maybe India is not only transfer pricing, but overall tax in general.
But this is from, and this is also from a former commissioner in India. They are doing stuff that we stopped doing in India 10 years ago. Like the year-end adjustment that Ibu Lily was talking
about. Okay, thanks. Okay, maybe last question for the evening from anyone. Not you again, Bu Lily. You've got 3 questions.
You're mute. I can mute you. I'm a host now. I'm a host. Yeah, I can mute you.
Too many already.
You've got your umbrella after this. Okay, anyone else? Okay, otherwise, probably just one last question for me, because I mentioned in the beginning that I'll let you explain a bit history behind your Indonesian names, Iwan. If you don't mind, so everyone can get to know you better.
Yeah, my name, that's actually quite difficult because this is not my passport name. But and that makes life a bit more difficult in Indonesia, because in the Netherlands and in Singapore, no one ever questioned it. So my business card just says Iwan Ho. But here, HR said, cannot. Have to use your passport name. And so I was like, yeah, but no one uses it. Even my mom doesn't use it. So Iwan is just a misunderstanding about my real name. And the story behind it that I have been told but cannot verify anymore is that my grandfather, who was working in the Netherlands, announced to his team, "Oh, I'm a grandfather now. I was the firstborn, and I have a grandson." And the team, of course, asked, "Oh, what's his name?" Yeah, Iwan. And so they said, "Oh, Iwan." And that name stuck. So my parents have always referred to me, as long as I remember, my family has always referred to me as Iwan. In retrospect, 2 things I did wrong by going overseas. One is not paying attention to my health insurance, and 2 is I should have changed my legal name. Because it's actually not that difficult anymore in the Netherlands.
All right. Thanks, Iwan. So
these
everyone...
are tips for overseas assignments. If you're Indonesian, especially for Indonesians, if you're Indonesian, have one name, change that before you move overseas.
Okay, interesting. So everyone, as we come to the end of today's session, I'd like to extend my sincere thanks to our speaker for sharing such valuable insight and experience with us. I'd like to thank all participants as well for your active engagement. thoughtful questions and contribution throughout the discussion. So I hope you find this session interactive and beneficial, and that you can take away practical insights to apply in your professional work. And on behalf of IKPI Jakarta Selatan, thank you for joining us this evening. Have a wonderful evening and stay safe. And we look forward to seeing you again at our future event. Good night, everyone. Have a great weekend.
I've been trying.
Okay, thank you.
Thank you.
Thank you,
Stay
everyone.